Hello everyone and welcome to this module on VA loans. Let's begin by discussing the differences between conventional and non-conventional loans before we hop into VA loans. So non-conventional loans are government loans. They include things like FHA loans, VA loans, and USDA loans. Conventional loans, on the other hand, are mortgages not part of a specific government program. These are private programs. They're not government insured or backed. And there are two categories of conventional loans. Conventional conforming loans, which conform to the standards of Fannie Mae and Freddie Mac, and conventional non-conforming loans, which do not conform to the standards of Fannie Mae and Freddie Mac. So let's talk about VA loans. Now, a VA loan is a type of non-conventional loan. It's a government loan, and therefore it's a non-conventional loan. It's guaranteed by the Department of Veteran Affairs, or the VA, and it's available for active duty members, retired veterans, and eligible spouses. Now, VA loans finance primary residences only. They cannot be used for secondary homes or investment properties. Let's talk about VA loan eligibility. A certificate of eligibility is issued by the VA and serves as a reliable proof of eligibility for a VA loan. Now, for veterans separated from service, the Certificate of Eligibility requires the veteran's DD-214. The DD-214 is also known as the Certificate of Discharge or Release. Now, dishonorably discharged veterans do not qualify for a VA mortgage. For veterans still in service, the Statement of Service must be obtained, and the Statement of Service replaces the need for the DD-214. Let's continue our discussion on VA loan eligibility. Now, a minimum of 90 days of active duty is required to be eligible for benefits for those serving during wartime. And here, wartime is defined by the Department of Defense. A minimum of 181 days of active duty is required to be eligible for benefits for those serving during peacetime. And here, peacetime is defined by the Department of Defense. Discharged veterans must have at least served a 2-year term to be eligible for the benefits, and those in reserves or the National Guard must have at least served a 6-year term to be eligible for benefits. Let's talk about VA loan qualifications. Now, the VA does not place a minimum credit score requirement for VA loans, so lenders set their own policies on credit scores when it comes to VA loans. The total DTI, or the back-end DTI requirement, is 41%, and there's no down payment required for VA loans, so the LTV could be up to 100%. Now, for VA loans, there's something called residual income that must be calculated and factored in before qualification of the applicant. The residual income is the income left over each month after paying all major expenses. So this is the income left over each month for expenses such as food or gasoline and things of these sorts after paying all major expenses. Now, the MLO is required to fill out what's called a VA loan analysis form to determine the residual income qualification. Let's talk about the Certificate of Reasonable Value, or the CRV. VA loans require a VA appraisal, and the value of the property is documented by the Certificate of Reasonable Value, or the CRV, which is issued by the VA. So the CRV establishes the maximum value and loan amount for the VA loan. Now, for VA loans, there's something called a funding fee. The VA requires the funding fee, and the funding fee supports the cost of entitlement and guarantee. We'll talk about entitlement and guarantee in a bit. The VA funding fee is a one-time fee, and the funding fee depends on the amount of down payment placed. So take a look here. If the down payment is less than 5%, then the VA funding fee is 2.3% of the loan amount. If it's 5% or more, then the VA funding fee is 1.65%. If it's 10% or more, then the VA funding fee is 1.4% of the loan amount. Now, this is for first use of a VA loan. After the first use, the funding fee differs. So if the down payment after the first use is less than 5%, then the VA funding fee is 3.6%. If after the first use, the down payment is 5% or more, then the funding fee is 1.65%. And if after the first use, the down payment is 10% or more, then the funding fee is 1.4% of the loan amount. Now, there are exemptions to funding fees. The following are exempt from paying a funding fee. Recipients of Purple Heart on active duty are exempt from the funding fee. Veterans with a service-connected disability are exempt from the funding fee. And recipients of dependency and indemnity compensation as the surviving spouse of a veteran are exempt from the funding fee. So let's talk about VA entitlement. Entitlement is the amount that the VA will guarantee for a VA loan. And the amount of entitlement is the following. It's $36,000 for loans of $144,000 or less, and it's 25% of the loan amount for loans greater than $144,000. So what is the VA guarantee? The VA guarantee is the amount that the VA is willing to pay a lender in the event of a foreclosure. It protects the lender against loss. The VA guarantee will come from the borrower's available entitlement. Now, in case of a prior default or an outstanding VA loan, the guarantee is limited to 25% of the loan amount or county loan limit set by the FHFA. So the lower of either the loan amount or the county loan limit is utilized for the calculation of the VA guarantee. Importantly, VA loans are assumable if the new borrower can qualify for the loan. So the new borrower must be creditworthy, and the purchaser doesn't have to be a veteran. Novation is the term used to describe the process of releasing the original borrower in exchange for the new mortgagor. And this concludes our module on VA loans.